Before we dive into why waiting for candlestick closures is essential, let's first break down what a candlestick actually tells us. Each candlestick represents price movement within a specific time frame, whether it's 1 minute, 1 hour, or 1 day. For a bullish candle, price opens at the bottom of the body. The low of the candle shows how far price moved down before buyers stepped in. The high shows how far price pushed up before sellers started to take over. The candle closes at the top of the body, confirming buyers were stronger during this time frame. For a bearish candle, it's the opposite. Price opens at the top of the body. The high shows how far buyers tried to push before sellers dominated. The low shows the furthest sellers pushed before buyers stepped in. The close is at the bottom of the body, confirming sellers had the upper hand. Now, why does this matter? Because until a candlestick closes, all of this movement is unconfirmed. Let me show you what I mean. Look at this example. The market is trending upwards and hits this level of resistance, then reverses. It pulls back, hits the same level again, and shows signs of rejection. Right now, the candle hasn't closed yet, but we can see what looks like a clear rejection, potentially signaling a reversal. Now, if you jump in at this point without waiting for the candle to close, you're basing your trade on incomplete information. Here's what happens next. The market closes bullish even though it initially showed signs of rejection. That rejection was only temporary, and after the close, the market revealed its true direction. It broke strongly above the resistance, confirming a trend continuation instead of a reversal. Finally, by entering too early, you would have been trapped in a false signal. This is why waiting for the candle to close is so important. It gives you the full story and prevents costly mistakes. Let me share an experience from my early days of trading, one that taught me a lesson I've carried with me throughout my long journey in the markets. I remember analyzing a chart where I had identified a clear supply zone. The price had just reached the zone and it formed a perfect pin bar signal. At the time, I was confident this was a strong setup. I placed a sell order right after the pin bar closed, set my stop loss just above the supply zone, and used a Fibonacci extension to determine my target. My target was at the 0.68 Fibonacci level, which is often considered a golden level. It was a swing trade on the daily time frame, and for the first and second days the market was calm. But on the third day, I started checking my screen periodically. In the morning, I saw the candle forming in my favor, moving away from my supply zone and reinforcing my analysis. But later in the day, the market started to push up against me, and the candle began inching closer to my stop loss. Fear kicked in, and I thought to myself, this is going to hit my stop loss. I should close the trade now and minimize my losses. Acting on that fear, I panicked and closed the trade before the candle even finished forming. But here's the kicker. The candle hadn't closed yet. When it finally did, it turned bearish, confirming my original analysis. At that moment, I was so frustrated that I made an impulsive decision and missed out on this trade entirely. Days later, the market continued in my favor and eventually hit my profit target. But it was too late. I was no longer in the trade and the opportunity was gone. By acting out of fear and closing the trade prematurely, I turned what would have been a winning trade into a losing one. That moment was a wake-up call for me, a lesson in the importance of waiting for candlestick closures to see the full picture before making decisions. Now, let me show you how smart money uses your impatience and impulsive trading decisions to trap you. This strategy is called the fake closure candle strategy, and it consists of 4 key candlestick formations. The first candle in this setup is the range candle. This candle sets the boundaries for the market during the day. The high of this candle marks resistance, the level where price struggles to go higher. The low of this candle marks support, the level where price struggles to go lower. These levels are critical because they define the range for the setup. Next, we have the inside candle, which forms completely within the range of the first candle. This candle shows consolidation or a pause in the market. It's a sign that the market is undecided and building energy for the next move. At this point, we know the market is in a range, but we're waiting for the next candles to give us more information. Here's where things get interesting. The third candle,